Hello, everyone, and welcome to the latest episode of Meet the Investor. Joining us today is Kelli Marti, Senior Managing Director and Senior Portfolio Manager at Churchill Asset Management, a US-based private credit manager focused on the traditional middle market space there with US dollars of 53 billion of committed capital. Thank you so much for joining us today, Kelli.
My pleasure. Happy to be here.
Kelli, we usually start with asking our guests to tell us a little bit about themselves, about the firm they work for, in this case, Nuveen and Churchill, maybe the history of Churchill as well, and the involvement of TIAA, who they are and why does that make Churchill a little bit different to a traditional fund manager.
Yeah, absolutely. Happy to. Well, starting with myself, I've been in the direct lending, leverage lending market for close to 30 years. So basically, my entire professional career. At Churchill, I serve as a senior managing director and the senior portfolio manager for our retail and wealth products. So, a little bit of history on Churchill. We've been investing in the traditional middle market since 2006. We've been a leader in the market, focusing on PE backed traditional or core middle market businesses, which we define as businesses average EBITDA of about 50 million. So in 2015, Churchill was acquired by Nuveen. Nuveen is a $1.3 trillion global manager of public and private assets, including 125 billion of private capital. So when they acquired Churchill in 2015, importantly, that allowed TIAA to become our ultimate parent company. TIAA is a Fortune 100 company here in the US. They're one of the highest rated insurance and retirement providers in the US. They're very focused on private capital as an asset class, and they have a very strong appetite for investing in the private capital asset class, but particularly in private equity funds. So we've allocated about 12 billion of capital from TIAA that allows us to invest directly in middle market private equity funds. And we're currently an LP in 325 different funds. So that in turn drives our deal flow and our sourcing of assets. So a big differentiator for us and a huge benefit of being part of the TIAA umbrella.
Okay, so you provide the debt to a private equity company looking to purchase a private business or a public business, but effectively a business they're looking to invest in. And you will provide the debt capital to those private equity companies in that particular space of businesses making about $50 million of EBITDA, US dollars. Why do Churchill focus on that middle market space in particular?
Yeah, we find the middle market space incredibly attractive for a few reasons. Well, if you think about the definition of middle market, it really becomes synonymous with the word private capital. And private capital spans a very large range of business sizes. We see the lower middle market, which we would define as companies generating 20 million or below of EBITDA. We have the core or traditional middle market where Churchill focuses, where businesses are generating somewhere between 20 and 80 million of EBITDA. And then you have the upper middle market, what I would characterize as businesses generating north of 80 million of EBITDA. And we are focused on that core traditional middle market, which we find very attractive because we're able to have very conservative capital structures in this segment of the market. We're typically levering our transactions around 4.5 times senior leverage. We're getting very strong documentation to support our investments. We still have financial maintenance covenants in our market, which allows us to test the cash flows and the EBITDA of our borrowers on a quarterly basis and make sure they're complying with those financial maintenance covenants. And we're still getting very attractive pricing. We're getting SOFR plus 475 to 500 for the assets that we underwrite. So attractive yields, conservative capital structures, tight documentation, and importantly, financial covenants. So we view it as a very attractive space in the market to invest in.
So SOFR being the effective US cash rate, so about 475 or 4.75 to 5% over the cash rate is the lending rate you're providing. How does that differ to what banks would do when they're lending to businesses, and why aren't banks more active in this space in the US?
Yeah, I mean, banks were participants in the middle market for a long period of time prior to the GFC. And after the great financial crisis, banks tended to retrench or get out of the middle market space. And the reason was they were looking to reduce their exposure to loans on their balance sheet, to leverage loans on their balance sheet. Instead, they wanted to underwrite to distribute. So they would underwrite these large transactions, typically in the public debt domain, and simply distribute the entire loan to other investors, mostly CLO investors. So banks were able to generate fees that way and stay active in the market, but reduce their exposure to these businesses on their actual balance sheet. So they moved away from the private markets more primarily into the public markets and allowed lenders like Churchill to continue to gain market share in the private market, which we've done so, again, being a lender in the space for almost 20 years.
So there's that process that you described before with covenants and understanding cash flows of the business. Is that effectively what banks would have been doing historically when they do provide lending? Is there any difference in terms of how you operate to how banks may have operated historically? Is that the way for an investor to think about what you do?
Yeah, I mean, you hit the nail on the head exactly. So sponsors are looking to buy these businesses. It's what we call leverage buyout, and they're seeking debt capital from private capital managers like Churchill. And typically, if we're looking at these transactions, say a business is being acquired for 10 times or the 10 times purchase price multiple, a lender like Churchill will provide about 40% of the capital structure in debt, and the private equity firm will provide 60% of the capital structure in equity. So banks had the ability to do that, but again, they were looking to get those loans off their balance sheet. And it's very important in the private capital space when you underwrite a loan to hold that loan throughout its life. Sponsors want to transact with lenders who are what we call buy and hold investors. So we're entering into these loans at the inception, and the expectation is we'll support that borrower through that 6-year life of that loan until it's ultimately repaid. So for banks to change their mindset and look to syndicate or sell those loans off their balance sheet didn't fit well with what the private equity sponsors were looking for in a lender partner. So we describe this market as very much relationship driven, whereas the public markets, where the banks are now participating primarily, is very transactional driven. So those loans are buying and selling, they're trading on a daily basis, there's liquidity in those loans. Whereas in our market, a sponsor is very careful to choose lenders to be participants in their lender group that they know will stay with that company for the full 6 years of the life of the loan.
So a sponsor being the private equity company itself. Um, you mentioned 6 years a couple of times there. Are all transactions 6 years? Is that an average life? What's maybe you can give a typical example of a particular deal as well while you're going into that.
So yeah, our legal tenor for these loans is to 6 years. In a normal market environment where sponsors are buying these businesses, they tend to spend a few years professionalizing the business, maybe growing it through some tuck-in acquisitions, and then ultimately selling that business to another private equity sponsor. The average life for these loans is somewhere between 3 and 4 years in a typical market. In today's market environment, sponsors are holding onto these businesses a little bit longer, but the legal life of the loan is 6 years. Again, the average EBITDA of most of the businesses that we're entering into for a new transaction is around 50 million of EBITDA. And really what we look for are businesses with strong market leadership, a reason to exist, businesses that have pricing power, businesses that have strong management teams that we spend time with during the underwriting process to get to know and vet the management teams. We look for businesses that don't have a lot of cyclicality to their demand patterns. We want to see non-cyclical demand patterns. And importantly, we're aligning with equity sponsors that are in the top quartile of private equity firms. So we are very careful with the types of private equity firms that we're aligning with. And from a security perspective, we have a first lien on all of the assets and a pledge of the equity of these businesses. So from a senior loan perspective, we're sitting at the top of the capital structure, first in right of repayment, with the strongest security underlying our loans.
So you lend with your partners being the top quartile performers of private equity market. You have the first right of repayment in terms of where you are in the repayment stack for if there's an issue with a company, and you take security against the company's assets and the equity itself. Do you have could you run us through an example of how a deal might start from, I suppose, the origination of the deal all the way through to the lend itself and then the repayment of the capital? Do you have an example you could run us through?
So I'll give a couple of examples actually, and in businesses, the types of businesses that we like to see. One that we recently underwrote was a company that provides consumable dental equipment. So when you go for your 6-month dental exam, it's the equipment that's used once and then thrown away. So these are consumable products. They have recurring revenue. It's obviously non-cyclical. Folks don't tend to skip their dental appointments. And this deal was sourced from a private equity sponsor that we have a long term, deep seated relationship with. So the sponsor showed us this transaction opportunity because we were an LP in their fund. We spent weeks underwriting the business, spending time with the management team, spending time with the equity sponsor, understanding the investment thesis, doing all of our due diligence, modeling the transaction through multiple model scenarios, and ultimately approving that loan. And we were awarded the lead agent title for that transaction, which means that we're the ones holding the pen on the negotiation. So we're negotiating that credit agreement with the private equity sponsor, and we were awarded the highest commitment. So there were two other lenders in the lender group, but we were awarded 60% of the transaction because we had that LP relationship and we were able to underwrite and commit to the entire deal. So they awarded us 60% of the capital structure, and that's a newer deal in our portfolio. Another example of a company that we underwrote and were awarded the lead agent title that we've grown with is a business that makes signage. They make signage for warehouses and parking garages and restaurants. So again, non-cyclical demand patterns. It was sourced from a private equity sponsor that we were an LP investment with. We were awarded the lead agent title. And the exciting thing about this transaction is we started with a deal size of about 150 million, and that company has grown through acquisitions. So it's allowed us to provide incremental financing along the way, and our commitment now to that business is close to 300 million. So it shows the power of having these PE relationships to source assets from, allows us to win the lead agent title and have that mandate. And then when you have that lead agent title, you have the ability to, grow with those businesses as they make acquisitions and provide that incremental capital. So it allows us to deploy more capital to those businesses. So both of those were big success stories for us, and businesses that we like, again, with that non-cyclical and recurring demand patterns.
So, is the main advantage of the lead agent on those deals the ability to increase the lend if the loan is going, if the company is going really well, doing really well, or are there any other advantages of being in that position?
Yeah, it certainly is what you just described. Being the incumbent allows you to provide that incremental financing if they look to seek financing for an acquisition. But importantly, you're the main point of contact with both the private equity sponsor and the management team. So, for example, when we're the lead agent, and we're the lead agent about 80% of the time on our transactions, we have the ability to call the CFO directly of the business. So, we provide revolvers for all of the loans that we underwrite. We track the usage of those revolvers on a daily basis. So, for example, if we see something that looks unnatural or unusual as far as a revolver borrowing, we can simply call up the CFO of the business and ask him or her about the use of proceeds and what was different about that revolver borrowing. So, just that constant communication is very important. Also, down the road, if we get to the point where we're negotiating an amendment with the sponsor, perhaps there's something going on from a covenant reset perspective, or they're asking for some change to the credit agreement, we're leading the negotiation for that amendment. So it's important there to have that leadership role as far as negotiating amendments down the road.
Um, so with the returns you described earlier, or at least the rates on the loans, SOFR or cash rate plus nearly 5%. Those loan rates and ultimately the returns that would be passed through to an investor seem very high, particularly when compared to what you might get on cash. So evidently this is 5% over cash, or any lending to an investment grade quality public company. When there's so much extra return to be had, that tells me Finance 101 that there's more risk. Can you tell me a little bit about the risk there, and what might happen if things go wrong with the business, given the risk involved?
Mm-hmm. It's a great question. And just taking a step back, I would say that risk is associated with lending too much to a business, over-levering the business and taking unnecessary risk in the sense of, will you get your loan repaid and your interest repaid? And so the way that we protect against that risk is making sure that we're aligned with sponsors that we know, that we trust, that we have long-term relationships with, and importantly, sponsors that are investing more in the business than we are as lenders. So in that example I gave earlier, a business that's valued at a 10 times multiple, we're providing 4 times of the capital structure, they're providing 6. So our loan to value in that case is 40%. So for us to not receive our principal back, the value of that business would have to deteriorate by 60%, which is highly unusual. Why? Because we're choosing the most attractive businesses. The sponsors are choosing the most attractive businesses to purchase. So you really have two parts of vetting of these businesses: the sponsor, first and foremost, finding the businesses that they view as attractive. And then, second, Churchill, as a lender, vetting these businesses that we find as attractive. So, for a company to lose 60% of its value after all of that process is very, very rare. So, structuring, first and foremost, is very important. Aligning with private equity firms that have deep pockets, having capital to support these businesses in the future should something go wrong, is important. And also having less investment in those businesses than the private equity firms themselves is very important. So risk is in itself could creep into this market, but it's all about who you're aligning with and how you're structuring your transactions. And importantly, if something does go wrong, if the borrower does fall into some sort of financial softness, how do you negotiate that situation with the sponsor? And in our case, because the sponsor has more investment in that business than we do, we have very constructive conversations. So if they're looking for a reset of their financial covenants, we will provide that in exchange for something from the sponsor. And that something from the sponsor is typically additional equity. So you have the right alignment. That's very important as you seek these opportunities.
So just to press on that a little bit, this sounds, best businesses pre-selected by the sponsor. Churchill do their due diligence all over the balance sheet and their future cash flows. I'm still not sure why the loans are priced so attractively in that case.
Right. So as sponsors look to transact, and they can choose a public debt solution or a private debt solution. A public debt solution, to your point, will be less expensive. They're usually about 150 to 250 basis points less expensive than a private debt solution. But there are very distinct advantages to transacting in the private debt market, and that is speed of execution. You're aligning with lenders that you have a long history with. You're often transacting with 2, 3, or maybe even 4 lenders, as opposed to the public market where you're transacting with dozens of lenders. You have to get a public rating if you're transacting in the public market, and that's expensive, it's time consuming, and it's very exposing to that business. When you get a public rating, the whole world can read your rating letters from S&P or Moody's, and they know if you have a misstep along the way, all of that is out in the public domain. So sponsors that are choosing to transact in the private markets with a company like Churchill eliminates all of that. You don't have to seek the public rating. You have certainty of execution because, again, you have a very nimble and small lender group, and you have lenders that are going to hold that transaction throughout its life. If you're transacting in the public market, lenders are buying in and out of those loans on a daily basis. So the lender group that you start out with at origination will be vastly different than the lender group that you end up with if you are seeking an amendment down the road. So there's a lot of benefits to transacting in the private markets, despite the fact that you're going to have a higher interest rate.
Okay. Private credit has been coming under a lot of regulatory scrutiny in Australia and globally as well. There's been a lot of focus in the news around the regulators getting having a deeper look at this space. What are your views on why that might be and what changes might be afoot as a result?
Mm-hmm. Well, the private credit market has existed for decades, right? I mean, I started my career 30 years ago in the private credit market, so it's certainly not a new asset class. What's different is that it's grown tremendously. And when we think about the banks retrenching and exiting from the space, private equity sponsors seeing the benefit of transacting in the private markets, the growth has been substantial. And that's what's garnered all the headlines and all of the scrutiny. And as a result, we have had new entrants attempting to get into the space. And so that's what the scrutiny is about, the growth, the new entrants. Is it a bubble? Is it sustainable, et cetera? And when we see new entrants trying to get a toehold in the market, it's very difficult for them to do. Why? Because these deals are sourced directly from private equity firms. And those private equity firms want to transact with lenders that they trust. So a brand new entrant into the space to try to win a mandate on a new transaction, it would be difficult for the sponsor to just go with a kind of an unknown lender versus transacting with lenders that they know and trust. So we're not seeing new entrants really gain a significant toehold in the industry. So it has been beneficial for lenders like Churchill, who have been in the space for a number of years, to be able to appreciate this growth in the asset class because we continue to increase our market leadership as the market grows. So when we think about the scrutiny and, is it a bubble? It's not. I mean, the white space in the market in the U.S. alone, if we think about the number of businesses that are characterized as U.S. middle market businesses, it's over 200,000 businesses. And currently, less than 10% of those businesses are owned by private equity sponsors. So the white space is tremendous, which will help the market continue to grow. And truthfully, when you have businesses of this size, if you have a business that's generating 40 to 60 million of EBITDA, it's really not a candidate for the public debt markets. It's really too small to transact in that space. So the private credit space is the perfect solution for those types of businesses. And again, the white space is vast.
We've talked a lot about lending to private equity and private equity being a key part of this market. Private equity itself has come under a little bit of scrutiny with fundraising not being as high as historically, leverage being more expensive because of higher interest rates, and the M&A market, mergers and acquisitions market, where they can sell assets back or away, being quieter over the last year or two. How do these trends spill over into the private credit space, into your market in particular?
Well, private equity firms having difficulty fundraising isn't necessarily true. If we look at the dry powder that's been raised by private equity firms versus the dry powder that's been raised by private capital providers such as Churchill, the private equity dry powder exceeds us by 4 times. So they have been very successful in raising new dollars. They're looking for strong opportunities to put that capital to work. So from a fundraising perspective, if they're putting a little bit of a pause on that, that's actually not a bad thing because we can start to chip away at some of that dry powder gap between private equity and private capital. As far as the cost of debt, I mean, that was definitely a hot button when SOFR was 530 basis points, which it was for 6, 7 quarters here in the U.S. It's now come down about 100 basis points, and our spreads have come down in the last year. So all told, a new senior debt investment today will cost about 150 to 175 basis points less than it did 18 months ago. So the ability to support that debt and to pay your interest is actually becoming more affordable for borrowers. So we're seeing, SOFR come down. It's expected to come down a little bit more by the end of the year. All of those are very positive for the private credit space. So we're not seeing that as a big obstacle right now in the private credit space. The M&A activity, I mean, it certainly has come down from its peak in 2021. That was the frothiest market we had seen in some time. That market definitely reversed in 2022, and M&A activity declined quite a bit. We're seeing a very stable flow of business right now. M&A activity came back in 2024. As it reached the levels it did in 2021, certainly not, but we're seeing a steady flow of new deal opportunities, allows us to be incredibly selective and continue to typically say yes to less than 10% of the deals that we see. So we're seeing an appropriate amount of deal opportunities to maintain our selectivity.
And finally, looking forward, what are the biggest opportunities in this space, the asset class generally, and for Churchill as well?
Yeah, if we think about the asset class in general, there's been significant growth in what we call asset backed finance, which is securing pools of collateral, and that could be aircraft financing, music royalties, automobile loans, et cetera. So that is a subset of private credit right now that's growing pretty substantially. So when you see growth in the asset class, it's also important to consider the other types of assets that are leading into this growth of the asset class as a whole. It's not just leverage lending and financing leverage buyouts like we do at Churchill. But if we look at growth opportunities for Churchill specifically, we see massive opportunity continuing in the retail and wealth channels. We have a few products in the channel already that offers exposure to Churchill's senior lending investments, our junior capital investments, and our equity co-investments. But we see a lot of opportunity to provide retail and wealth customers access to our private equity instruments as well. So we're very excited about the continued growth in the market, about our continued growth in our market share and our positioning in the market, and bringing those opportunities to the retail channel.
Kelli, thank you so much for taking the time to talk to us today.
My pleasure. Absolutely.